Good day, everyone, and welcome to the annual GTR America's Trade Leaders Roundtable. My name's Shannon Manders. I'm GTR's editorial director, and I am delighted to welcome you to this fantastic lineup of speakers. I'd like to start off by asking them to briefly introduce themselves before we hand over to our chair for this discussion. Let's try and do this alphabetically. So, Dan.
Hi, Dan Son, head of our global banking group at US Bank, which is our bank's coverage business and our global trade and supply chain finance.
Hi, everyone. Inwha partner and practice leader at IBM for banking financial markets, focused on cognitive process transformation.
Hi, everyone. This is John Monaghan from Citi. I head up Treasury and Trade's Working Capital Advisory Group based here in New York.
Hi, John Richman. I run Santander's trade and working capital business in the US. Well, pleasure to be here. Thank you.
Hi, Joon Kim from BNY. I manage the global trade finance and distribution and portfolio management.
Hi, good morning from Texas. Keith Murphy, JP Morgan. I manage the North America trade and working capital finance business here at JPM across the corporate and investment bank, so mostly the Fortune 500.
Hi, I'm Patricia Gomes. I run trade finance for HSBC in North America.
Hi, Jeff Brady, head of global trade and supply chain at Bank of America, based in New York.
Excellent. Well, on that note, thank you all very much for joining us. And I'll hand over to Jeff Brady to guide us through the next hour. Thanks, Jeff.
Thank you, Shannon. So this is the part of the program where I normally welcome everybody to Bank of America Tower in Midtown Manhattan. And point out some of the scenic views. We will be dispensing with that part of the program this year, sadly, but we look forward to doing that again soon enough. And of course, you're all welcome to come up to the tower when and if things get back and we open back up. So we've got a really good program today, as I think we always do, with some great speakers around the table, as always, very prominent people in trade finance and very prominent people that are based here in North America. So as we think about this as a North America focused event, you know, we do sort of, we like to have that presence from the folks based in North America. And also that's why, you know, it falls to one of the US banks to host. So we're happy to do so here at Bank of America. So let's get right into it. And I think, you know, what we'll try and do is really just touch on some of the things that are very prominently sort of being talked through, and all of the things that we are discussing as an industry. What's important, I think COVID is probably the big story. No surprise to everybody. You know, we've got elections coming up here in the US and other things. So let's get into the discussion on what kind of impact we think that will have to trade finance and to the broader industry and economics, et cetera. So let's start off, and I'll ask my my good friend and well-known prominent industry colleague, Patricia Gomes. And, you know, we think about the upcoming US elections. So of course I will be going around the table and asking all of you to give me a prognostication on that. I'm exaggerating that, of course. You think about COVID-19, trade tensions, macroeconomic shifts, and all of this stuff affecting the trade landscape. So Patricia, with somewhat gloomy outlooks for GDP, trade flows, resulting, I think WTO, we saw a number recently saying that global trade is going to be down sort of 10-ish% this year. What impacts are you seeing in trade flows, specifically as they sort of impact North America? And resulting, you know, what have you seen in the industry around these major events that we've seen in 2020?
Sure, absolutely. Thanks, Jeff, and pleasure to be with you and the team here. I think that, you know, you've talked about, you know, trade tensions and protectionism. We were seeing that, you know, before the pandemic already, and that was already affecting trade volumes, certainly in North America, but globally as well. What's happened is a lot of these topics have been exacerbated by the pandemic. So whether it's significant supply chain finance disruptions in terms of logistics, whether it's frankly demand destruction in certain sectors and in certain regions, you're seeing very uneven both closing and reopenings throughout the world. And I think there's also some long-term adjustments that you're going to see in terms of some things that may not come back. For example, what is the future of work, and what is telework going to do for some of the industries that survive around the office environment? What's going to happen in terms of the production and supply chain of some of the essential goods and, for example, medicine? So there are some things that you may see actually long-term adjustments after the pandemic. But you're absolutely right in terms of the GDP challenges. We've seen, Q1 this year, I think it was around 5% decrease in the US in terms of GDP. Q2, you're looking at around 30% reduction in GDP in Q2. That's very, very significant. Now, if you look at data more into September, you're seeing some of the import data in the US a little bit come back. So there's a little bit of green shoots there. But undoubtedly, the economic impact has also impacted trade volumes in North America. And that has definitely suffered. We have seen, however, a significant increase in supply chain finance because of a lot of interest in supporting suppliers. So that has been a big increase in terms of the trade volumes in the industry.
Inwha, you had a comment.
Yes, thanks, Jeff. So just wanted to add to what Patricia was saying. I completely agree with what she just mentioned, just bringing it down a level. I think beyond the kind of macro GDP and trade flows, which is probably more of a medium-term issue that the US companies are looking at, I think we have to think and look at sectorally. So there's some fundamental differences in what's going on from a sector perspective. The biggest hard hit in the short term in the US is industrial and consumer goods retail, right? And if you look at the impacts there, they're very much concerned with the immediate concerns, both from an operational standpoint and of course, liquidity and capital as well for SME and middle market. Probably not as concerned in manufacturing yet in terms of trade and tax, but more around operational and how do they pay their employees when a lot of the work is on site. And then you look at consumer goods and the big shift in consumer behavior, is that permanent? It's not just during COVID, is that permanent? And how do you then create a B2C and B2B strategy change for these companies in the consumer goods sector, as well as a backlog of orders, which is a tremendous pain point right now for the consumer product companies. And how do you create that demand sensing and flexible manufacturing close to the consumer? So I think that location change and how do they operationalize that for the consumer goods company is a big kind of macro and operational short-term issue. And of course, you look at tech, the sector that I'm in, it's also very different from those other sectors. And it's around, the hard tech versus the services tech. And there are fundamental differences in what's going on and how the macro factors are impacting us. So if you look at the smartphone production decline, around 12%, servers down 16%. But if you look at our AI and the kind of soft tech, let's call it, in services as remote work online, these kind of sector solutions are required. There's a massive increase in terms of the demand for different types of talent. So I think these sectoral shifts and fundamentals are changing very quickly in the US. So just wanted to point those out.
Thanks, Inwha. John, you had some comments. John Richman.
So, yep, thanks. So if I look backwards a little bit, it's been a fascinating year for sure on multiple levels. There's no question, we're looking at trade volumes down pretty hard globally as well as in this region. If I go back to the early stages of the crisis around March, April, the corporate need for liquidity skyrocketed, as we all know. Commercial paper markets broke, and companies were putting in all contingency measures possible. And what was pleasing in all that, if there is something pleasing in all that, is that trade finance performed well compared to these other forms of credit. And as usual in a crisis, trade finance delivered. And I think for a lot of companies, they will continue to see, if not more so, see trade finance as a reliable source of liquidity in times of stress. And so now, companies have taken various measures and liquidity has increased very substantially. And while the pressing need for liquidity, at least in large corporates who have done well in the crisis, may be less, I think companies see the need even greater. And I certainly agree with what Inwha said. It's very sector specific. Some sectors have done very well in the crisis, and some have done terribly. And within that, you see the separation between the haves and the have-nots has never been greater. So some companies are investment grade, flight to quality, they are awash in liquidity, and then others who might be their trading partners are exactly the opposite and under quite a bit of stress, which under those circumstances is where we as trade bankers play our most vital role. So it's created more opportunities, I believe, for the future for us to help our clients, not just as an alternative source of liquidity, but putting in programs that help our companies manage their own liquidity, and now even more importantly, the liquidity of their trading partners.
Thanks, John. And I want to follow up on something that Inwha and Patricia had noted. So particularly pre-COVID, there had been a lot of attention paid to shifts in supply chains. Post-COVID, I think, and I think pre-COVID, that was probably sort of more related to where would the sourcing be coming from, and would the lanes be changing out of China to other places. And I think post-COVID, there's probably another chapter added to that, which would be a shift in the goods, where historically companies may have been producing other types of consumer goods or retail goods, now going from alcohol production to hand sanitizer production or medical masks, things of that nature. So we think about that that shift in supply chain has now been bifurcated a little bit. I'm just curious as to your sort of experience with your clients and in the industry on what you've seen in terms of the shift in supply chains, both from that pre-COVID perspective and post-COVID perspective. And maybe Joon, Kim, I'll start with you, and then John Monaghan, I'd like to get your thoughts on that as well. Joon?
Yeah, hi, Jeff. So I think your commentary is absolutely correct. So when we are talking about the supply chain financing, I think we've seen a greater volume increase in specific industry verticals. So I think Inwha was making the comment, when you even look at the retail sector, the traditional retail versus e-commerce, there is a significant delta in terms of how you classify those industries now. So I think the traditional retail segment has suffered a great deal versus the e-commerce or the retailers, which has able to create an e-commerce strategy, has done really well. So the volumes that we're seeing is supply chain, and both on the receivable side is a large corporates that does a lot of domestic supply chain financing. The volumes have picked up greatly, versus a historical traditional segments such as the computer hardwares, the manufacturing. Sorry, my dog is a little barky, so my apology. Where the volumes are impacted on the cross-border suppliers, the volumes has been significantly down. So I would totally agree with you that the domestic side has done a much better job.
Thanks, Joon. John, if you've got a dog, we'd love to hear from your dog as well. But other than that,
I'm actually one of the few folks in the office today, and it's quite refreshing. But no dogs in the office today. But following up on Joon's point with respect to what was happening in January. Shifts in supply chain, mostly caused by tensions and trade wars, onshoring back here in North America. But more recently, and we've got over the initial concerns back in March with, as what was stated before, with slowdowns in basically all industries. But what we're seeing now is, to what John said, the haves and the have-nots. So the big box stores that remained open continue to acquire goods and services, still need trade finance. And then we're also seeing on sectors like aviation, some parts of industrials, still having concerns in terms of where to source goods and services. So a lot of attention is being focused on the credit aspects and the resiliency and sustainability of our clients' suppliers. So a whole series of questions and concerns raised by our large corporate clients on how to support their supply chain overall. So that's been a major shift in terms of working capital solutions to the benefit of the large corporate, now looking at how the sustainability with onshoring, new suppliers, what are the financial health of those suppliers, and how do we continue to support them? And we're seeing a lot of need for new supply chain products, whether it's pre-shipment finance or even going back to the traditional letters of credit when we talk about PPE. Early on, we had many companies for the first time that were acquiring goods and services related to their health of their employees in the factories. So they weren't acquiring masks and other cleaning supplies. So that was a new corridor for those companies to acquire goods and services. So, the traditional letter of credit or financial standbys, we also saw an uptick in that regard as well. So, a lot of changes in the environment with respect to the haves, the have-nots, and what going forward, looking at from a sustainability point of view, how do they support the supply chain? And that's what we're seeing here at Citi.
Thanks, John. John, Richman, you had some thoughts?
Yeah, I think that the name of the game has shifted a little bit in terms of supply chain management. So, it was all about efficiency before, and company just in time, or company deeply embedded automated processes, and companies now recognize the need for agility and resilience in how they manage their supply chain, and within that, risk awareness, risk management, and perhaps less efficiency is what you'll see going forward. So, companies are maybe having to shift even the products that they're making in some cases, as we've seen, trying to localize manufacturing or regionalize it, not be so dependent on China or any one particular supplier. And that's clearly all happening. And as John was saying, that increases the need for trade finance. So you end up with new trading partners who are less well established. There's more risk involved in the process, and again, that's where we step in as trade finance providers. So it's all managing those concentration risks exist within the supply chain. They also exist in how you manage your liquidity. So treasury functions are looking at that as well. So before, a lot of my clients might have said, well, commercial paper, or whatever other sources they have, does the job the cheapest and the most efficient, perhaps. And now they see trade finance is not just helps me manage working capital metrics and supports trading partners, but is a very good alternative liquidity source. Even if it's a little more expensive, it's more reliable. And so it's all been about how you increase agility and resilience, and efficiency may be taking a backseat in the post-COVID world.
Thanks, John. Patricia, I know you had some thoughts.
Yeah, just two quick things. John mentioned, the whole just-in-time concept, which reminded me of, the change from just-in-time to just-in-case is what we call it, right? In terms of that risk management aspect. So John, you're absolutely right. And the other thought I wanted to share is that what I find is that the topic of managing supply chains has now really become kind of a CEO head of business conversation rather than a treasury finance conversation, because it's now not just about optimizing your business, it's about the survival of your business. Are you still going to be able to produce the goods? So it's just risen in a whole different level in terms of the agenda of the CEO.
Thanks, Patricia. So I want to move on to I think what is still close to many of us and our clients in the industry: supply chain finance, reverse factoring. It's known by a number of different things. And I want to get some thoughts from Daniel and then from Keith as well. John Richman had sort of made a point that I want to follow up on a bit. and I think it's absolutely right. Trade finance continues to show well. And you think about supply chain finance or payables finance, I think has really shown well through now the financial crisis and I think through COVID, and really sort of established itself as a very viable and important source of liquidity. And I think most of us would agree, we'd like this to go as deep as we could in terms of those supply chains so that we can really get the value to, I think, where it's needed most. But just in terms of what you've seen out of the performance of supply chain finance, the demand from clients, where it's sort of positioned itself in the industry, Daniel, love to get your thoughts on how you've seen that progress post-COVID. And if you want to go back to sort of how it performed in the financial crisis, et cetera.
Yeah, no, thanks, Jeff. And apologies in advance. I lost my voice over the weekend. I'm just getting it back. No, thanks for that, Jeff. Yeah. So I think the theme really this year, and obviously there's an extension from pre-COVID, but if anything, the pandemic has proven to us the resiliency of these programs. For one, certainly there was a lot of activities during the end of Q1, and it was interesting. Combination of both existing clients. Obviously, there's a lot of drawdowns, new facilities being put in place, and just putting the whole structures around supply chain and the uncommitted nature of the discretionary nature of this, just actually seeing it come through for the companies have actually boded well, again, in terms of the resiliency and the value proposition of what these programs were intended to be in the first place. And then what's happened from that is companies that, of course, have either not looked at these programs in the past or have looked at it and deprioritized. Obviously, we've seen a resurgence of that coming back in terms of interest. But as many of you already stated, it has been a tale of two cities, right? So even within sectors itself, like on the consumer goods, on the retail side, obviously there are some many that are struggling, but then there are other retailers that are thriving. I mean, I think every other person that we know either got a new pet right during COVID or doing some kind of home renovation project. And so you look at pet foods as an example, you look at the home improvement, the DIY stores, if you will, are thriving right now. And so you're seeing pickups and increase in demand from sectors that we, just to oversimplify, are struggling. But again, even within those sectors, we're seeing an increase in demand. So having to also re-educate the stakeholders internally with some of the sectors that are out of favor, if you will, that there's real demand coming into play. I think the $1 million question, and I'll finish with this, is what you said, Inwha. Is this sustainable? Have we already established a new norm, or is this just temporary, or something in between, maybe? And that's what I think we're all trying to figure out.
Thanks, Daniel. Keith, we'll turn to you for some thoughts from JP Morgan perspective on supply chain and where it sits and how it's performed.
Yeah, no, and thanks for the question, Jeff. I think, broadly speaking, as people have already pointed out, we're kind of at a bit of a K economy recovery. You've got the haves and the have-nots. Certainly across companies that already had supply chain finance programs embedded, we've seen a massive uptick in utilization from suppliers that have reached out, that are interested in joining these programs. We've also seen companies challenge us as a bank on how we can get deeper into the supply chain. I think all of us here recognize that over the past decade, when a lot of these programs were launched, the bank supply chain finance programs only targeted, maybe your top strategic 100, 200, up to 500 suppliers. But I think given the confluence of not just the pandemic, but then also all the ESG initiatives out there right now, we've been challenged by a lot of our customers to say, hey, what can we do for the suppliers that we don't just buy 10 million from, but what can we do for those suppliers we buy $500,000 from or $100,000 from? As companies want to try to ensure that the entire supply chain gets access to early payment liquidity. So it's been on one effort, we've seen a massive uptick in demand on our existing programs. But I think more broadly, what we're focused on right now is how can we capture more of the supply chain for our customers, right? which is something that I think a lot of corporate customers have challenged us to do, particularly as these programs have shifted from just being a working capital tool that Treasury wanted the procurement team to do to one that I think Patricia highlighted earlier, which is this is now being managed by the procurement teams and the business leaders in a strategic way, saying we need to get early payment liquidity to all of our suppliers. And so for us, it's this whole pandemic has kind of created the opportunity to reinvent ourselves. And I'm sure as an industry, a lot of us are kind of seeing that right now. And so I'm excited about supply chain finance. Hopefully we can make sure that the negative press kind of stays out of the way, and that we can show that these programs do sustain supply chains in a viable way and offer suppliers attractive early payment liquidity, which has just become all that more important in this particular crisis, just like it did in the last crisis when we saw it pick up. So from our perspective, as I'm sure is no surprise to all of you here on the phone, supply chain finance is at the frontier of where we see growth in the trade finance business, particularly in the Americas.
Thanks, Keith. Inwha, I know you had some thoughts, and then John Richman and John Monaghan. I do want to follow up on the point around the negative press as we go forward, but Inwha, to you.
Yeah, just a couple comments from a corporate standpoint. I think I'm the only corporate here, so I just wanted to add a few comments. So absolutely uptick in supply chain finance. I think we all agree on the demand coming from that, particularly as there's extension of terms from buyers, as well as cash flow issues from suppliers that are kind of coming together in terms of the demand, right? So that's the current market demand. But I think more importantly, I just wanted to highlight a couple points. One, I mean, as we all know, the supply chain finance structure for investment grade companies like IBM and large strategic suppliers, right? So I grade US corporate with the big suppliers, that's now commoditized. And I think, any bank who has a tech platform to do that is able to do that. And the game changer there is around the speed and how digitized is the platform. But pricing and structures are commoditized, and it's all about how cheap and fast you can go. I think the more important area of supply chain finance I want to highlight is the middle market supplier base, including IBM's, right? It's the smaller SME middle market supplier base that, frankly, most banks still can't take the risk of. So I think that's where the biggest demands are, right? And that's where we, as a financial banking community in particular, that's where the gap is in supply chain finance. It's not the I grade to I grade. And then second point I also want to make is it's not just about supply chain finance anymore. So we work with a lot of corporates, not just ourselves in the world of supply chain. It's about supply chain management. How do banks and non-banks provide additional services beyond just the commoditized financing? I think that's going to be the name of the game in the near future. How do you expand financing into supply chain management? How do you integrate with our corporate ERP systems? How do you create that seamless supply chain management? I think that's kind of the future to come. And then last point, as we saw this year in the US, new players entered this market. So if you think about Blackstone, if you think about Goldman Sachs starting transaction banking, these all happened during COVID. And these are scalable players, some banks, some non-banks, and they're all tech enabled without the legacy system burden. So I think there's new competitive players emerging that have scalability. So just wanted to mention those points.
John Richman.
Yeah. So a lot to chew on there. So a few things. One is I think what's changed during COVID is the motivations of corporates to roll out these programs. Pre-COVID, it was all about working capital metrics and cash flow. At peak COVID, if you will, it was about managing their own liquidity as an alternative source. And as we've progressed, it's become much more about supporting their trading partners, especially those in some stress. It's about rewarding good behavior. So, companies doing good ESG type initiatives has definitely accelerated, and also keeping their sales channels alive and hopefully thriving, through terms extension. So the reasons for doing this have increased. No question that companies still are interested in their working capital management and metrics. And to the earlier points raised, our job as trade bankers is to continue to expand that value proposition. So as was said, I think by Inwha, just providing commoditized funding post-invoice acceptance is not going to be good enough long term. We need to be able to do that first across a wider range of trading partners. So it's not just high grade to high grade, as you said, but also SMEs who really need it. Also event-based finance earlier in the process, again helping expand the proposition, and any other kind of value add like FX conversion. And expanding the capacity of these programs through capital markets players, could be new entrants to the business or what have you, and of course end-to-end automation. Jeff, you mentioned around some of the issues in the business that were raised around the rating agency viewpoints or accounting opinions, and obviously those are concerns. I think you and the BAFT organization have made some good progress, getting some more clarity there. There's still more work to be done. And those will remain concerns, but at the end of the day, the value is absolutely there. The tremendous value proposition we offer, not just to high-grade corporates, but SMEs, companies in emerging markets, companies in stressed sectors who need help. And this provides real value. There's no denying that. In the end, I think that carries the day. Thanks.
Yeah, and before we get to John Monaghan, just to follow on, as John Richman had noted, one of the things in the industry that we had done was we had created what we call the payables principles, as sort of the chief practitioners in the industry of reverse factoring or supply chain finance. And I think all the folks around this table were involved in that in some way. And effectively, it really is just to take a little bit of a position to answer some of the negative media. And by the way, any media that wants to sort of opine on supply chain finance is welcome to do so. I think from our perspective, and I think Keith made the point earlier, what we're sensitive to, I think, is when things that are not necessarily what we consider to be supply chain finance or reverse factoring are construed as such in the media. And I think that clouds the conversation as we think about the implications for things like accounting treatment, or the implications for things like how companies use this structure and this technique. If we're not talking about the same thing, it tends to cloud the ultimate issues. And I think the effort behind the payable principles, which really just effectively is a definition by the practitioners of what we consider to be supply chain finance. And it doesn't mean that there aren't other structures and schemes that are out there that banks are very comfortable doing. It's just not what we consider to be supply chain finance. So we do want to focus, I think, the conversation a bit. And I think as John Richman alluded to, I think that's been useful for us in just, the reaction and, the receptivity from the community has been, okay, well, it helps then to understand this is a good conversation starter for us. It's a good discussion starter as you think about all of the branches where that conversation goes, as we said, whether it's accounting treatment or whether it's sort of what the ultimate use of the structure is, et cetera. Because I do think, you do have this, different parts and segments of the community that really sort of sign up for the great benefits of the liquidity and the structure to, as we talked about, as Inwha said, the SMEs and the value of that structure. And then you've also got the questions that probably, as we always say, the boundaries have never been set in stone for what it is. So I think the payables principles was an effort to do that. But anyway, John, I know you, Monaghan, I know you had some thoughts earlier. I want to just get to you on the supply chain finance topic.
Yeah, just to add to the payables finance principles, I think all of us on the call today adhere to, particularly in North America, how a proper payables finance structure should work with our clients. And I think, in talking about earlier, Jeff, I wanted to express what we've seen in terms of resiliency of supply chain finance payables programs and how they've performed over the period from January until today. So I think the performance, when we look at outsiders, whether it be the rating agencies or the accounting firms, and the treatment or continued treatment of payables, I think these payable programs, properly structured, adhere toward these principles, and we've seen a very positive outlook on these programs. And And to add to Inwha's comments, what we are seeing, though, is not just the extend terms, working capital, liquidity benefits to the large corporates, but also how do you extend these benefits to the SMEs? And in that regard, whether it's as comments that were noted before, the C-suite is very much focused on not just on their own sustainability, but also on the entire supply chain. So how can these programs bring forth solutions to the broader set or the long tail of suppliers? And that's going to take some technology. I suspect we'll get into that, what role fintechs can have. But that's what we're seeing in terms of that. I'll hold off on any conversations on the accounting side, because that could be a whole day's conversation.
Yeah, so let's talk a little bit more. And you talked about digitization, obviously a topic we've been talking about over the last couple of years. I always love to get Patricia's perspective on this. So I'll start with Patricia, but obviously, Inwha, your view would be useful here as well. And Keith, I think you were the one that brought this up in the first place. So thinking about digitization, it's a topic we've been talking about for a number of years. Obviously that, and sort of thinks about a couple of different topics. One is, how can we go more paperless? One is, how can we be more efficient and be able to reach more parties? And then last but not least, and I think this was a topic we weren't talking anything about a year ago, remote capabilities. And I think, all of these things rolled into one. COVID, how has that changed or kickstarted what we're thinking about in terms of digitization? Has it put that a little bit on rocket fuel? Has it really just accentuated the need for all of the things we're doing around digitization? Have we seen the industry, particularly the corporates, say, enough with the paper, we need to move away from it and we needed to get more digital? There's been a lot of talk about it. I think it's really been an inertia question, really more about a technology question over the last couple of years and the motivation for that. So again, Patricia, I'll start with you, your thoughts.
Yeah, Jeff, no, listen, I think you hit the nail on the head. I think it's, whether you want to call it rocket fuel or COVID's been the great accelerator. It's been a great accelerator because the technology for the most part is there and exists and is being adopted with various degrees of intensity by various parties. The problem is, as we all know, we need an ecosystem to adopt it so that it actually, creates the critical mass to be effective. So I think COVID is a great accelerator for digitization. I think that whether it's, we've talked about going deeper into the supply chains for the SMEs are the lifeblood of the economies. We've seen that now. And being able to get the financing and getting those SMEs onboarded in an effective and an efficient way, being able to manage the risk on a database, based on data, so that we can manage the compliance risk of onboarding those suppliers is absolutely key. This is where management of data and technology is going to come into place. All this is available. It's a matter of adoption. We've had a lot of corporate clients, call us and say, thank you for being such a pain when you were really forcing us to use a digital channel and not taking our faxes, because guess what? Now what it means is that we can actually process and you guys are open for business where some others aren't. So I do think it's been a great accelerator and a great differentiator, and really quite binary in terms of being able to be open for business or not being open for business. And that has sharpened the focus of regulators, of industry bodies, and of corporates to jump on the bandwagon. So I do think you're right. It's rocket fuel, Jeff.
Inwha, I'd love to get your thoughts, and then Keith, maybe you as well.
Sure, it's definitely rocket fuel. And I think it's as how fast can everyone go is the question among the trade finance banking community. But what we call, IBM calls it the intelligent workflows across the supply chain. So that's a big trend going on across corporates. And I do think that the financial markets need to connect into that, particularly as we think about supply chain finance, working capital, et cetera. So what we call intelligent workflows across supply chain is what we're seeing. And that's an integration across buyers, suppliers, and some financing companies to connect seamlessly across the supply chain process. So that's one. I think that's a big trend. It's already happening. And I think it will just increase as well. I think second area, which impacts banks directly today, is the hyper-automation of our operational processes. I mean, that's a must-have now. I think it was always there, and some banks were ahead of it versus others, but that hyper automation of the operations process in the mid to back office now is just critical with folks working remotely. And then I guess the third area we're seeing, Jeff, is definitely around the AI analytics, right? How do you create that both for corporates and banks, and even create it as a service to corporates? So corporates, again, are very much ahead on this. And I think banks are, definitely working in this space, but it is around predictive analytics, specifically around customers, suppliers, and buyers, as well as on the financial crime side around AML analytics, sanctions analytics. Those two areas I think are super hot right now. We're of course focused on it, but so are all our corporate and banking clients as well. And the third area I would say, around trade digitization is, Patricia said it, future of work, remote working. How do you really change that? Because that's a shift, right? In banking as well as in corporates. How do you fundamentally shift that? And of course, as a tech company, that's probably one of the busiest areas for any tech companies right now, big tech, fintechs, right? We're enabling that future of work. And what that really means is redefining what employees do. So taking out all the kind of paper-based manual tasks and creating a different profile and skill set that the employees need for the future. So it's not just about sticking in technology to automate it, but really changing the culture of what should our employees be doing more as decision makers versus administrative work. So there's a huge shift going on in the banking industry right now on that. Some trade finance businesses are looking at it, but I would say just banking overall, that's a huge shift.
I mean, it's funny you talk about the future of work. I think we've spawned a few more branches on that conversation in the last 6 months, right? The future of work also includes where will that be and how remote do we need to be able to be, and many topics under that flag. So I think the future of work becomes a very interesting topic, not just around how we're going to do it, but also where we're going to do it and who's going to do it. Keith, would love to get your thoughts as well on the topic.
Yeah, you're right. Everything's kind of been pretty much covered for the most part. It's changing the way that people work. It's changing the type of work that people do. And it's creating really a need to remove friction from the entire ecosystem. Not just the front end, the way that we interact with customers and their suppliers, but also internally, right? And in terms of digitizing, we've done a bit of a mind shift on working with fintechs, and we announced one earlier this year. And it's really incredible what the fintechs can bring to the table, and how adept they are at taking technology and really redefining the way that people interact with each other. And the use of machine learning and data analytics. And we're just now trying to get our heads around all the different touch points within the entire ecosystem that can impact, whether it be our operations team, basically having some of their work automated now, so they're no longer having to shuffle paper around and can focus on more value-added tasks, to the way that we engage suppliers in a supply chain finance program, or get even deeper into the tier on that. We've been approached by IBM on some other things as well. And it's pretty fascinating that, COVID, everyone was kind of humming along at kind of just a nice, easy pace. GDP was up. There was a little bit of concern around maybe onshoring and some of the tension between the US and China and what that might mean for supply chains. But COVID has completely changed the whole world in which we operate in. And now, everything is about scale and digital, and how can we redefine the way that people work, given that we all now have limited resources to be able to do the work that we want to do, and we want to scale that work. And so it really forces us to think about how we can use technology. And so to that end, Jeff, we've been working with fintechs to digitize as much as we possibly can, and even doing simple basic stuff like the simple task of asking customers to use DocuSign to execute documents as before sending paper, wet ink documents, right? That's changed. That's kind of low-hanging fruit, but now we are thinking about the models entirely. Can we do things in a much more digital way that can scale and not have that human intervention, right? And interacting and signing paperwork and removing the friction from the entire ecosystem. So yeah, we could spend a whole day talking about it, but it without a doubt has been a catalyst for a lot of change, which is, can be a good thing for all of us.
Thanks, Keith. So I want to shift gears a bit, because I think, as we think about, things that are prominently sort of being talked about, discussed, actioned in the industry. And I think top of mind for all of our clients, for us as well, many of our institutions have strategies around it. ESG. And again, I think this is pre-COVID. I think it's continued, during COVID. But I think, we've seen ESG creep into many of the discussions we've had around trade finance, around our solutions, around which counterparties we're willing to work with, et cetera. And I think our clients have also sort of noted the same. So I'll start with Daniel and Joon, and I want to get your thoughts, but obviously this is a very prominent topic, so welcome any thoughts that others would have, but Daniel, we'll start with you.
Yeah, thanks, Jeff. Yeah, so when we think about ESG, I think, not a new topic, obviously, we've all spoken about, but what's interesting is what we're seeing from customers, and in light of, I guess, what's happening in the landscape, just in the country, are actually diversity, equity, inclusion related programs as it relates to trade. Where we're getting inquiries about, can banks help set up a structure where they want to give their minority-owned suppliers, some type of a priority program, if you will. So it's interesting how the ESG side is actually also there's a DEI, or a diversity, equity, inclusion component to it. So yeah, I just wanted to maybe just mention that first. And I think it's a little bit in the infancy, and whether we can use an existing program to structure what these clients are looking for, while we're talking about an entirely new type of program that we would need to set up to try and facilitate. But either way, it's interesting seeing an increase in requests more around DEI within the ESG umbrella.
Thanks, Joon.
Yeah. So from our side, I think the ESG strategy, or the journey of the various financial institutions, are still work in progress, right? So we saw at our bank a couple of weeks ago, we finally saw what we call ESG applications of all the clients that we are dealing with. And it is a very micro level application that tells us exactly whether it's on the bond issuance versus the trade finance or the cash management side, in terms of exactly what the corporate strategy is and how they execute their ESG strategies. And we're reviewing the profiles of the various client base, and not all lines of the businesses are going to have exactly the same types of a ESG journey, right? So to trade finance, we can talk about different things, whether it's child labor to green, to different aspects, whether oil and gas or eco-friendly, etc. So I think it is critically important for the bank or the corporates to establish a certain applications, rather than, yes, ESG is important, but exactly how are we going to execute that strategy to assist the corporates and the clients who are going through that stage is what we are going through. And it was great to see that, as maybe sometime last year, people talked about the importance of it. And maybe perhaps many of you guys who are on the call, the banks have already established the applications, but it was great to see that our bank has also established an application so that we can view the profiles of each corporates and how it fits into the overall journey that we're going to be taking with related to the ESG strategy.
Yeah, thanks, Joon. I think, interestingly, I think one of the parts of the journey for all of us as practitioners has really been around the qualification of the ESG or the D&I, where the credentials are, or the certifications, where we don't have to just sort of take somebody's word for it, right? I think that's again, we always talk about standards as being a baseline for a lot of what we do in the industry. And I think that's probably one that we're all looking forward to getting a little bit more clarity around on all those fronts. John, Richman, I know you had some thoughts, and then John Monaghan as well.
Right, thanks, Jeff. So yeah, I mean, I think pre-COVID was early stage, but I think as COVID has acted as a real accelerator. So there's a lot of action in the space coming from both banks and corporates, and I know we are actively working on programs, and Jeff, to your point, trying to develop those standards, working with experts in the field, third parties who can validate what is a qualified project, or what's a qualified counterparty or client. There are quite a few in the space, and there's a lot still to be defined. But this is quite real now, and clients are almost demanding it. And for a lot of clients who might have put certain trade finance related projects on the back burner because they're so liquid, if you have a solution that is ESG compliant, where they can reward a supplier, for example, for doing good, that can get a program going. Everybody is recognizing this. We have a lot of work to do in terms of defining those standards, coming up with frameworks and scorecards, but it is well underway. And I think the next push will be more at the sort of the government and the regulatory level, where we can, today we can offer some incentives, but only within a range. But, at a certain point, if a regulator is able to offer capital benefits for projects that are green, or companies that are socially responsible, or what have you, then we can offer very, very tangible economic benefit to all the parties involved. And that's the next leg of the journey. But this is moving fast.
Indeed. John Monaghan, I know you have some thoughts.
No, I would add, pre-COVID last year, very much focus on the environmental side of ESG. And what we're now seeing is more, I think you raised the point, Jeff, on the diversity angle of suppliers, and how those small businesses, minority-owned business, woman-owned business can be supported through programs like supply chain finance. I think all of us have, our corporate charters, an ESG strategy, and focusing on various UN principles that have been identified. All of our corporates are doing the same. So how can we marry the social responsibilities of a corporate with something like supply chain finance? And I think it's a natural progression, and it lends itself well to support any of the ESG aspects, whether it's environmental or the social aspects, by putting forth a supply chain finance solution. So, the difference from last year to this year is 100%. All of our clients are talking about it, and the trick is, to John's point on the environmental side, getting that standard. There are companies out in the market today that are facilitating the look and validation of suppliers in terms of environmental aspects, rating them. It's still early phases, but I suspect we'll see a lot more of those companies out there to do the validation. The diversity suppliers here in the US, I think it's not as challenging, because there are associations and small business administration that can identify a particular supplier. So I see that aspect as a lot easier for our trade finance business in North America to help support the diversity suppliers as well. But we're seeing a lot of activity.
I would agree. I think, the certifications, the credentials are a little bit more evident in that space than they are on the ESG front. Inwha, I know you had some thoughts as well.
Yes, I'll just add, since we're a client of most of you, just some of the stuff that we're working on. So we're in sustainability. I mean, we've been investing and creating intelligent systems that can provide actually the actionable insights and time relevant data across the supply chain, and how you can track and monitor and control the ESG factors across the supply chain. And the 4 areas we've been focused on is around smart grids, water, traffic, and food. Traffic gets to the disruption in the transportation and managing that flow, as well as the CO2 emissions. So those are the areas that we've been focused on, and we've been creating with other corporates, just so you're all aware, other corporates that are also your clients. So as an example, we've created the Food Trust. It's an ecosystem of buyers, suppliers, manufacturers, retailers across the industry with the likes of Nestle or Walmart, for example. And that's really for us all in the corporate community to track the supply chain bottlenecks, monitor the brand trust of Nestle and Walmarts and IBMs of the world, as well as safety in the food supply chain. So I just want to mention those. It's real. It's being operationalized. It's not just some metric. And a lot of the U.S. Large corporates were working together to create such systems and ecosystems.
Thanks, Inwha. So we've only got a couple of minutes left. So what I'd like to do to spend the last couple of minutes is we'll go around the table, and in a minute or less, we'll think about, Inwha, your point around the future of work. Let's think about the future of work, the future of trade. What will the rest of 2020 bring, early 2021? What changes do you expect to see? What do you think the key themes will be for trade finance? John Richman, I'll start with you only because you are at the top of my Zoom screen. So then we'll go from there.
Okay. Right. So very hard to predict the short term. I mean, do you think there's a second or third wave, more lockdowns coming, or do you believe vaccines and a V-shaped recovery? Do you think there's going to be more trade wars or trade friction or more nationalism, or do you see companies developing more new markets? What about fintechs and capital markets players? Are they going to be competitors or collaborators? Will they be additive to the industry? Then of course you always have the accounting concerns that you mentioned earlier. But ultimately, I am super optimistic about trade and trade finance. At the end of the day, it has lifted hundreds of millions of people out of poverty. And the good of it is undeniable. And the good of the trade finance industry and facilitating that is equally undeniable. And we bring value to our clients. We bring value to SMEs, which is the lifeblood of most economies. We help reduce risk. We help increase sales. We become an alternative source of liquidity more so than ever. And in times of crisis, we are seen as most essential. And crisis always brings that to the fore. So I can't tell you what the next couple of months will bring exactly, but I can tell you I'm optimistic long term. The challenge for all of us is how do we navigate the current waters to get to the other side? And what remains to be determined is who we work with, and every organization will have different priorities, but who we work with, how we get there, how we compete, that will differ amongst all of us here in the virtual room and other banks and other corporates. But ultimately, I believe in trade as a vital part of the economy, and I believe trade finance is vitally important to support that. Thank you.
Excellent. John Richman, Santander, thank you as always for your thoughts. Daniel San.
Yeah, thanks, Jeff. Well, obviously, prioritization will always be a theme, no matter pandemic, no pandemic. But certainly trying to be consistent as we can be is going to be a big goal for us. I think I'm sure you'll all agree with me here how well we've done, both clients and ourselves, just executing virtually over the last 6-7 months. And as we look forward, what's it going to look like in terms of servicing our clients and working with each other? Will it continue this way? Will it be a hybrid of some sort? And I think that adjustment, I have faith that we'll all adjust. We'll adjust well based on what the future holds in terms of how we will operate with each other and clients. So it will be interesting to see how that pans out. But again, the goal is to try and be as consistent as we can be. And agree with John. I think trade is a fantastic business. We know the value proposition, and it's just continuing that narrative and that message, both internally and externally. That it is a great business. We're here to help companies and the communities through all the things that we do. So, yeah, very much looking forward to next year.
Excellent. Daniel Sun, US Bank, as always, many thanks for your thoughts. John Monaghan.
Well, thank you, Jeff. And I agree with Daniel and John in terms of being optimistic about the next quarter as well as going into 2021. You know, as has been said, trade finance is key to supporting global trade flows, whether you're providing risk mitigation solutions or liquidity throughout the supply chain. We've been doing that for years. In terms of what's going to happen, I don't know what's going to happen with respect to the slowdowns and or increases, but I know that we have the solutions, whether they be providing risk mitigation solutions to clients and or finding liquidity solutions. They may be different next year in terms of how fintechs will play more of a role in electronic signatures, removing paper, working with consortiums, with Contour or Comgo and others that are out there in the market today. So I think you'll see an acceleration on working with some of these partnerships and looking forward to seeing what's happening on the expansion of some of these supply chain programs that we have today, the finance side, in terms of whether or not the technology, particularly here in North America, can be used to either support ESG initiatives and or small businesses to further, provide the liquidity to help kickstart the economy here in North America, as well as worldwide as well. So those are some of my thoughts, Jeff.
Thank you, John Monaghan, Citibank, as always, for your insights. Inwha.
I think for the future, Jeff, it's going to be about the survival of the fittest. Whether you're a bank or whether you're a tech or whether you're a corporate company, I think there is fundamental shifts going on. I don't think it's going to be business as usual. Survival of the fittest in terms of how do you enable, whether from a corporate perspective, it's a better customer experience, sustainability in the supply chain, all the stuff we talked about. And then from the banking sector perspective overall, and of course it impacts trade finance as well, is around loan loss risk reserves. How do you manage risk going forward, as well as how do you really create a tech enablement across the customer experience for banking customers? So I do think there is a shift going on, and it will be a very interesting 2021 as we see that going forward across the industries.
Thank you, Inwha. IBM, and again, many thanks for your insights as the only corporate on the panel, so very much appreciated for joining today. Joon Kim.
Hi, Jeff. So cautiously optimistic. I agree with John. Never know exactly what's going to be happening until the vaccines come out. So we have to forecast that could be a second wave, as well as the geopolitical tension that's creating the disruption on the overall supply chain globally. So we are cautiously optimistic. Assumptions we make is for the next few years, we're going to have a very low interest rate environment. At the same time, I think it was Inwha and everybody's talking about this. We just have to fast track and how we execute our trade finance transactions. So everybody within the trade finance banking industry knows what kind of assets, the asset classes that we're booking that's helping the world trade. Yet at the same time to execution, time to implementation continues to be a little bit slower than some of the other lines of the businesses, because we have so much paper, legal documentation, etc. So if we accelerate through that paper to digital process, amongst working with all the fine bankers and the corporates that are out there, I think if we can fast track that, I think the marginal value that we can create for the trade finance will be greater. And I think that's going to be the priority, should be the priority, as to how we automate more of the things that we are doing in a very manual manner.
Joon, Kim, BNY Mellon, thanks for your insights, and thanks for all of your work in the industry as well. Keith Murphy.
Yeah, just like the auto industry is in the midst of probably the greatest transformation they've seen in about 50 to 60 years, going from combustion to EV. Just like the internet completely radicalized the way that humans interacted, I think trade is about to go through that same shift. As everything becomes digital, it opens up a lot more information that's available to financiers and people in the entire continuum, which is why you've seen hedge funds and institutional investors become more actively engaged in the space. So what I'm thinking about is not so much just 2021 and what that means, which we're all going to go through a transformation, but really what's going to occur over the next 5 years, which I think is trade is just going to become more centered around capital market driven activity. I think banks will play a role in as much as we do today in fixed income, but as things become more digital, investors will have more visibility into underlying transactions, and we will see a shift to the institutional side. And so we certainly want to be a part of that here at JP Morgan. And we're going to support our clients who no longer have patience for paper, but demand digital and scale. So we're excited to see that over the next 5 years, and hopefully as an industry, we're well positioned for that shift, which I do genuinely believe will occur.
Keith Murphy, JP Morgan, many thanks as always for your insights. I will save the last word for my friend Patricia Gomes. Patricia.
Thank you, Jeff. As I look forward, I see three things. Number one is what I call work from anywhere. Let's face it, we're not going to be able to get away from this. Work from anywhere is here. It's possible, and it is the future. Number two is I think trade can lead the recovery. If you think about trade more broadly, making trade happen can lead the economic recovery, and certainly providing trade finance can help lead the economic recovery. And the third piece I see is what a shame if we don't harness the power of the rocket fuel around digitization and use that as an impetus to transform the industry. So that would be certainly a lost opportunity, and I hope that as an ecosystem, we harness that power. Thank you, Jeff.
Patricia Gomes, HSBC, thanks as always, and thanks for your work in the industry. I don't have anything more clever to add. I think the folks around the table have touched on all the things that we have in our scope, the digitization and the work from anywhere, and the shift to the institution rather than just the corporate. I think all of these things have been sort of buds, if you will, over the last 18 to 36 months, and now I think the rocket fuel has really put it on our radar to be able to sort of deliver some results. So 2020 has been certainly an interesting year, we'd all agree. I will say, this is a conversation I always look forward to and enjoy. This has been enlightening and fruitful, and it is never a disappointment. So with that, I will close it off. Shannon Manders, back to you.
Thank you, Jeff. And thank you everyone for taking part in this discussion. As usual, it's proven particularly fascinating. And thanks in particular to Jeff Brady from Bank of America for leading us so aptly through all of these topics. On that note, I hope to see you all again very soon, and please do take care. Thank you.